What I want to do is create for you the most thorough, in-depth educational video that you've ever seen on the volatility contraction pattern. Now, this video is going to be centered around identifying a high quality VCP setup, how we think about initially controlling the risk. We're going to do that both from a cup completion cheat, so that's going to be a lower pivot entry within a developing VCP, and then also a higher base breakout as well. So that higher pivot point, we're going to be thinking about how we initially control risk from those entry points, how we go about mitigating the risk, and then we'll talk a little bit about optimizing profits as well. MarketSmith are the sponsor of this video. There is a discounted trial available in the comments below. So with all of that being said, let's get straight on into it. I'm going to give you an overview first of everything you're seeing on the chart, so it's all making sense. Then we'll start diving into the details. So first and foremost, this blue line that you see here, this is going to represent price. Now, for the purpose of this illustration, I'm saying that the rally from somewhere down here to the peak up here was 50%, and the depth of the decline, where price then found supportive action on the 50 SMA, is minus 20%. And then you can see we build a VCP in here, so this is going to be our low pivot that we're going to be talking about. There's then a breakout. I'll be explaining all of these numbers. Then there's another VCP, which is then setting up around this 21 EMA, which is going to be the blue line. So the blue line, 21 EMA, or the lighter blue line, electric blue line, 21 EMA. Purple line is the 50 SMA. Then down here we're going to have our volume as well. So this black horizontal dashed line is going to represent the 30-day average volume. So you can see that there are peaks and troughs. Then what I've tried to do with this green area is indicate where the pivot is, because we'd like to see volume drying up. We're going to be talking about active risk mitigation as well, so how you can remove all of the risk from the trade. So the figures to do that, you're going to have to sell half of your position at a 1R gain, and this could be your initial stop loss, it could be your new adjusted stop loss. So we'll be talking about that with this red line and these dash red lines for both the entries. You could sell 1/3 at 2 times wherever your stop loss is, or 1/4 at 3 times, so 3R where your stop loss is. So let's start jumping into it. So we can see that price is in the context of an uptrend here. Now, I haven't put relative strength on here, but preferably you'd like to find a stock that's displaying excellent relative strength versus the market, versus its own industry group, if you're using the likes of MarketSmith as well. So we can see that the stock is powering up here. It's in the context of an uptrend. Let's assume that it's in a strong group. It's showing a lot of relative strength versus the market, versus the strong group as well. So then it finds supportive action on the 50 SMA in here, and then it starts bouncing. Now for the VCP, okay, commonly you are going to see a series of contractions, and those contractions are better if they're making higher lows. So it can be a VCP within the context of a developing base, because some of you could look at this as well and go, well, this is also a cup and handle type pattern. If I make this orange, can you see this? This is a cup and handle type pattern. So yes, you can have kind of that standard VCP itself, where you just have, say, 3 contractions, 4 contractions moving horizontally, but the volatility contraction is a characteristic you're going to see within other chart patterns, whether it's a cup and handle, whether it's the VCP by itself, a high type flag, a Davis box. So you'll see these little VCPs form within other chart patterns. Now, the moving averages you can use as a reference point as well. So if you see a lower pivot forming, it may be that you have some supportive action from key moving averages just underneath. So you see here how we bounce off the 50, and then we go 1 contraction, 2 contraction, 3 contraction. This is where we start getting nice and tight. So below the low of this first contraction, okay, this horizontal red line in here, we're going to say that this is an initial stop loss of 5%. But then we also see there's this kind of third and final contraction in here, where we have the 50 SMA and we also have the 21 EMA. Now that's going to be a 2.5% stop loss if we were to move it there, and I'll talk about that in a minute. So we have a stock that's in an uptrend, bounces off the 50, then we see it go 1 contraction, 2 contraction, 3 contraction, and then we take a look at the volume. The volume contracts in the pivot, so we're well below our 30-day average. So when we see that price is getting really tight, it's building those little high lows, there may be a couple of shakeout demand tails, some gap down reversal type candlesticks in here as well. But with the volume drying up, the multiple type candlesticks, what is this an indication of? From supply and demand? It's an indication that there is a lessening amount of supply coming which is coming to the market. Okay, supply is being absorbed. The analogy to use is if you think of a towel, if you dip it in water, you take it out, the towel is obviously dripping with water. Okay, if you were to wring that towel, okay, water is going to come out of it. You unspin it, you wring it again, less water is coming out of it. That is what these contractions in price are. It's the wringing of supply. Now, how do we kind of visually understand that there's less supply? Well, it's the fact that there should be multiple tight candlesticks, structural higher lows are forming, and the volume is also coming down as well. They are some things that you are looking out for. So we've identified a potential setup in here. So we're going to go, okay, we're going to target this, and the percentage figures aren't going to work. This is actually Amazon on the weekly chart. I've just kind of pulled it up here. Okay, but we're gonna target the stock here, and for the purpose of this, maybe we say it's $236, but these stop losses are not going to be at 5% and 2.5% with that. So let's just say our entry is going to be here, and we're going to place our initial stop loss underneath the low of these three contractions. So our initial stop loss is going to be 5%. Now, if you're swing trading breakouts through VCPs, your initial stop loss is probably going to be somewhere between 3% and 7%. That is going to be the norm. Really depends how it kind of plays out. So let's say we're targeting the entry through here, and we place our stop loss here. So what I'm already thinking about is I've identified it, I've controlled it. So let's imagine we get filled here. Now I'm into the risk mitigation. So my objective here is not to try and make a lot of money. My objective before trying to make a lot of money is to try and ensure that I lose very, very little money. So this is the mitigation part. Now I like to use what I call active risk mitigation. So what is active risk mitigation? Let's start talking about that. So my initial stop loss is 5%. And then what I see is the share price is actually able to get out. So let's just put it here, okay? So the stock actually breaks out like this, and now I have a 5% gain on the position. So imagine that I'm buying it here. I now have a 5% gain on the position. So when we then look over here, we can go, well, in terms of my initial stop loss, I'm up 1R. So if I wanted to free roll the trade, it then means that I could sell half of my position because I'm now at 1R, and I would free roll the trade. Let me just show you some really basic math just so this kind of makes sense. Okay, imagine if I had bought 4 shares. Okay, so I'm just going to write it 4 shares at 100. Okay, so I bought 4 shares at 100. My initial stop loss, so I'm just going to put SL, was at 95, but the share price now is 105. Okay, so I have $5 profit, but I had $5 risk. Let me just make this 2 so the math is then just even easier, so you can just follow along. So the share price is now 105. So I have $5 profit. If I was to sell 1 share would equal $5. Yeah? Profit. But my risk on 1 share equals $5. Does that make sense? So if you look here, imagine if this was our entry here. So if our entry here was at 100 and our stop loss was 5%, which would be 95. I appreciate these figures are obviously wrong, so ignore all these figures on the side here. But if our stop loss here was at 95 and then this 5% gain in this area here was 105, we have $5 profit. So if we were to sell one of our shares being half of our position, now at 1R, okay, over here, so 1R, we're selling 1 share at 105, but we're maintaining that stop loss at 95. We've made $5 and our risk is still $5 on the trade. So if price then turned around here and we were to get stopped out at $95, we're break even on the trade. Okay, so to save me typing it in and you hearing the keyboard, what I've done here is just done an illustration to show you what selling 1/3 at 2 times your stop loss looks like in terms of the math. So let's imagine here this is going to be a little bit different to this because these figures now aren't matching up. But imagine if we bought 3 shares at $100 and our stop loss was at $97. So if we got a 2R move of our stop loss, that would mean that the share price would now be $106. So if we were to sell one of our 3 shares, okay, at 106, that means we've locked in $6 profit. Now if we maintained where our stop loss was on the remaining 2 shares at $97, our risk on the 2 shares left
is $6. Okay, that's obviously it's 2 times $3 because we bought it at 100. Our stop loss is at 90 at 97. Okay, so there's $3 risk on those shares each. So 2 times, because we have 2 shares left. Okay, times the $3 is 6. So we've locked in $6 profit, but we still have $6 risk. So this is why selling 1/3 at 2 times where your stop loss is, especially if your stop losses are in single digits, means that you have free rolled the trade. So this is the active risk mitigation part. That is basically how the math works. Hopefully that is making sense for you guys. So when we're thinking down here, and this is where it's going to get a little bit complicated, so I'll try and break it down. I'll try and make it simple. If you have any questions around this is probably the part where you may have the most questions. So if you do have questions, just leave them in the comments below. I'll do my best to answer your question. So imagine if we're entering the trade here, okay, and we're going in with this initial stop loss of 5%. Now when price gets here to around about 5% in this green area in here, okay, we now have a decision to make. Okay, and this is where you can have multiple scenarios. So we're going to say trader A and trader B for the purpose of this. So would you rather be trader A? Okay, trader A has their entire position still on, but they have 5% total risk on the trade. Okay, that wouldn't be 5% to their total account equity. It would probably be somewhere more so between 0.5% and 0.75% of total account equity risk. But for the purpose of this, is a 5% initial stop loss. Or would you rather be trader B? So trader B goes, okay, now I have a gain of 5%. So the stock has been able to break out successfully. And then I see that, well, there's a couple of what I call trigger bars, those really, really tight candlesticks where the volume dries up. There's a couple of very tight trigger bars in here. Maybe there's a little shakeout demand tail as well. And then I see that the 21 EMA and the 50 SMA is in here. And there's this third and final contraction within this pivot. So what trader B goes is, well, I'm going to push my stop loss up. So again, you can start to actively mitigate risk by reducing the amount of risk you have. There's 2 main ways to do this. One is you can start pushing your stop loss up, and you could factor in a combination of part 2, which is you could sell part of your position. So I invariably do both. I look to sell part of my position and push my stop loss up as well, if it's prudent to do so. So here we go, okay, third and final contraction, 21 EMA is there, 50 SMA is there, and I could start mitigating the risk here. So I could push my stop loss up to 2.5%, which is actually then halving my total risk, because I've gone from a 5% stop loss to a 2.5% stop loss. But this then obviously changes the equation for us in terms of percentage gains to then free roll. So instead of having to have a 2R move on 5%, which will be a 10% gain, a 2R move on 2.5% is a 5% gain. Well, for the purpose of this, we're saying we've got a 5% gain here. So this here now, this 5% gain, if we push our stop loss up here, we are now selling at 2R. So 5% is now 2 times 2.5% risk. Hopefully that's making sense. So trader B goes, well, I'm going to push my stop loss up here below the contraction, below the 21 and 50 SMA, and now I'm up 2 times where my new adjusted stop loss is. I could sell 1/3 in here and I free rolled the trade. So trader B now has 2/3 of his position, but he has 0 risk to his account. This stock can now do no damage to his account equity line, theoretically. Of course, there could be a really big gap down on the earnings, there could be a lot of slippage, there could be a million and one things here. But if you understand from kind of a hypothetical perspective what I'm saying here, so trader B goes, well, I'm going to take this opportunity to free roll, because if the share price comes back down here, I'm going to be break even on the trade. But whereas if the share price came back down here for trader A would then have a loss of 5%, okay, which may mean that his account equity goes down 0.5%, 0.75%, whereas trader B is just coming out break even. For me, I much prefer trading like this, because it means I can try and free roll. I can then try and sit for a potential testing action. It just reduces a lot of the stress, a lot of the emotion out of trading as well. So my kind of mindset when I'm going into a trade is, okay, how quickly, this is a Sun Tzu Art of War quote, how quickly can I position myself beyond the possibility of defeat than I add prudently? Okay, I don't want to be doing it when I'm up maybe 0.5% or something like this and really tight. Okay, I'm a swing trader, I'm an intermediate term trend follower, so I have to at least let the trade play out kind of a little bit, start getting to those single figure gains of maybe 5%, 8%, 9%, for I'm really starting to think, okay, can I actively mitigate the risk here? But it is extremely rare. If I get a gain of around 10% on a trade, even kind of 7, 8, 9%, that trade is then going to do any damage to my account equity line. If it turns back around and comes down here, okay, if I'm getting gains of 7%, 8%, 9%, 10%, there is a very high likelihood that I have free rolled that trade. So my kind of mindset is, okay, how quickly can I mitigate the risk on the trade, and then I still have 2/3 usually of my position left. My favorite approach is selling 1/3 at 2R. But then what I'm looking to do is go, okay, I've got 2/3 of my position there. Can I get a double? Can I get a double, a treble, or quadruple? Can I 10x my money now, having no risk there? Now, am I going to be able to do that on every single trade? Double, treble, quadruple my money? No, it's on the minority of trades, clearly. But that is my mindset. Position myself beyond the possibility of defeat, then try and sit and allow the intermediate term trend to play out. I have no idea whether that intermediate term trend is going to be 5%, 50%, or hundreds of percent. I have no idea. I'm along there for the ride, and we'll start talking about the optimizing profits bit in a little bit when we come over to this entry. So you have a choice in here. I know that was a long ramble, but again, I wanted this video to be extremely in depth for this part here in terms of the active risk mitigation. You have a choice. Be trader A, be trader B, but be thinking about these levels. Think kind of objectively as well. Are there places? Is there another contraction here? Oh, is there potentially supportive action from a key moving averages, such as a 21 EMA, 50 SMA, maybe the 10 EMA, maybe it's a longer term base and you have the 100 SMA or something like that, the 150 SMA in there as well. Maybe it's the 10 SMA on the weekly or whatever. This is just how you can kind of think about early on in the trade, position yourself beyond the possibility of defeat. Another Sun Tzu quote that I like: invincibility lies in the defense, the possibility of victory in attack. So you can clearly never be invincible in the market. You are going to have losses, but the invincibility lies in the defense. These first three kind of phases of the process, if you like, identify, control, and mitigate, these are all they're very defensive in nature. The possibility of victory being an attack is from the optimizing profits part, but we have to get there first. We have to make that our risk management, our defense is sound, and we're building our trading on sound fundamentals. And this active risk mitigation, I think, will help you play much better defense. So this is then so if you look at these levels here, okay, so we have 5%. What I'm going to do, okay, is just keep these like this. So if you then start thinking about it, so if you think about these levels here, okay, what I'm actually going to do is just put these in. So this would be the difference for if you keep your stop loss at 5%, okay, or if you keep your stop loss, or if you push your stop loss up to 2.5%, okay, so you're plus 10%, which would be 2R. Okay, so these here, these 3R, 2R, 1R are all for the 5%. Now if we just do this in here, okay, so this is going to be 5% again, but this is now going to be 2R. And let's just change this to, say, a orange, so it just really stands out. That would be a 2R. In here, this is going to be 2.5%, which is going to be a 1R. So let's just start moving these a little bit, pull that down, something like that in there. And then this one here, okay, this is going to be 7.5%, which is going to be 3R. So you almost have to have an imagination of how the trade unfolds. And this is kind of, you may have heard me blabber on about kind of a Bayesian mindset. What does that mean? I think it's very important when you're trading. A Bayesian mindset means you are constantly updating your decision-making process as new information becomes available. In the stock market, when you're trading, new information is constantly becoming available. The market is always changing, price is changing, volume is changing, this is happening, that is happening. Relative strength is in this group, now it's in this group, now the market is selling off, now it's bouncing, now there's a follow-through day coming through. The stock was really strong, now it's not strong, now it is strong, now it is strong again, it's got back above key moving averages, bullish synchronicity bar. So again, you're never fixed to an opinion. You're just analyzing, okay, what is the market doing, what is the stock doing, especially then when you're in a trade as well, and then you're trying to make consistently high quality decisions over a large series of trade. So the difference here, and again, this is trader A and trader B, okay, trader B here, well, 3 times his stop loss here is 7.5%. So he doesn't have to get to 15% at 3R over here to sell 1/4 of his position to free roll. Now he only needs a 7.5% okay gain, and then he could sell 1/4 of his position at 3R. Okay, how much easier is it to get a 7.5% gain relative to a 15% gain? Clearly the probabilities are decreasing the further up the percentage gain has to be. So it's much easier to get a 5% gain on a trade rather than a 15% gain. It's much easier to get a 15% gain relative to a 50% gain, so on and so forth. So hopefully you're understanding this kind of active risk mitigation here. There's a lot of moving parts here. There's a lot of skill involved. It takes time to learn this. Obviously you'll get better with experience, practicing in a deliberate manner as well. You may have seen some of the bar by bar videos, but this here is then just thinking, as soon as you start pushing this stop loss up, okay, these figures over here for where you're looking to free roll are moving. Okay, the bull moves, the puck moves, price is always moving. You want to try and make some high quality decisions. So let's now just delete those. Okay, and let's talk about this trade over here. So I was thinking about kind of then saying that, okay, we free roll part in here. I'll tell you what, let's do that actually. Okay, so let's say, okay, you push your stop loss up here to 2.5%. okay, so then you have a gain of 5%, which is equal to our new stop loss. So we sell 1/3 of the position. Okay, so let's imagine on this first entry down here, you put 15% of your account in this stock. So you then decide, okay, well actually the share price is getting out here. I'm going to take this opportunity, push my stop loss up below this final contraction, 1020 or the 21 EMA, 50 SMA is there. I'm going to sell 1/3 of the position because I'm now up 2R my new adjusted stop loss. I free rolled the trade, and I was targeting this as a lower pivot. However, if the stock sets up another pivot, I could look to add back my position. Now this is the point you'll hear Minervini talk about it in the books, is using your profits from previous entries to finance your future risk. So if a higher pivot sets up, okay, we should have then profits on the trade that we can then use to finance the risk on the future entry. So here you have 10% of your account in the stock, okay, because so let's say entry was 15% of account. So I'm not saying this is a 15% stop loss. I'm just saying you put 15% of your account in there. So if you have a 100 grand account, this would be 15k you just put in. If you have $1 million account, it would be 150k, so on and so forth, right? But then when you have sold here, you now have around about 10% of your account in it. So over here, you're looking at this and you're going, well, it's setting back up again. So again, we're identifying, then we want to think about the control. So in terms of the identification, which is very closely linked to the control, we go, well, okay, price is getting back to the old highs here. Imagine that the relative strength is hitting kind of 52 week highs. There's a free tool on TradingView that you can use. Just search my name, you'll find it. Really helpful. And then over here, you can see, well, we have 1 contraction, 2 contraction, 3 contraction here. So okay, we have some nice VCP action. We're building the higher lows. We can see that the volume is trending down. It's well below our 30-day average volume, and we have the 21 EMA in here as well. So you go, okay, I'm going to add back the third that I sold. So I'm going to move this back up to putting 15% of my account in this stock. So here you go, well, my initial stop loss, I could go in at 7%. That would be underneath the 21 EMA. It'd be underneath the low of these final 3 contractions. Okay, and when the stock starts breaking out, it may also be underneath the 50 SMA as well. Or you could go, well, actually this final contraction is around about 4%, and the 21 EMA is there, so I could go there. Or you could go, and again, this is then trying to think steps ahead. So you're trying to play chess instead of checkers here. You could go, well, I could go in with an initial stop loss here of 7% on this 1/3 of the position. But if it starts breaking out, then I'm looking to mitigate the risk, continually mitigate the risk. Especially if it was a new entry, you could go, well, I'm going to push my stop loss from 7% up here to up to 4%. Okay, so again, it's then kind of active risk mitigation, pushing it up. So that is a way you can then be looking to add back on subsequent VCPs, but it's all in the context of a developing base as well. So what I want to do here is just imagine, okay, that we didn't take this entry, because I just want to talk through the process of mitigating risk again. So let's say we're just looking at this entry here, okay, so we're ignoring this setup here. We're just looking at this entry and we're going, okay, my initial stop loss is going to be 7%. So this is where I'm going to place it. But as the share price starts moving here, so let me just put this to a blue. As the share price starts moving out here, okay, you go, well, here, and this is kind of, hopefully this will drill the point home. I probably spent too much time doing it, but let's say here, at this point here, you have an 8% gain, and let's just put that in green. You have an 8% gain here. So again, trader A, trader B scenarios, right? So trader A, what does trader A have? Trader A has his entire account in this stock. He didn't have his entire account in this stock. He has his whole position, okay, with an 8% gain. But what is his risk on the trade? Well, his risk is still 7%, right? Because if the share price did this, and he gets stopped out down here, he's going to have a 7% loss, which again may be somewhere between 0.5% to 1% on his total account equity, something like that, right? Or trader B goes, well, I now have an 8% gain, so I know that if I half this, because that's going to be 2R, I could sell 1/3 of my position. So half of 8%, if my maths is correct, is 4%. So then it's, well, is there a logical place that I could push my stop loss up from 7% to around about 4%? So trader B goes, well, there's this third and final contraction in here. It would be underneath the 21 EMA as well. So why don't I push my stop loss up to this red dash line in here? Why don't I just push my stop loss up? Then it means I could sell 1/3 of my position, okay, and I free rolled the trade. So he has an 8% gain. So he decides to sell 1/3 at 2R, new 4% SL for stop loss, okay? 1/3 at 2R, new 4% stop loss. There we go. So you have a choice, right? Do you want to be trader A, who has still a 7% stop on this, or do you want to be trader B, who goes, I have 2/3 of my position left on this stock, and now the stock can do no damage, okay, to me. Okay, I would much rather be trader B. So if price then comes down, and if you traded for longer than a month, you'll know this, okay? Breakouts, fake out breakouts, okay, stocks break out, especially over the last 18 months. It's been much more choppy, much more difficult. Okay, stocks can kind of break out and then they do this. So instead of then getting stopped out with your 7% stop, or your 4%, or your 5%, or your 3%, or whatever, actually, if you can apply this active risk mitigation, it just means you can help yourself out in terms of managing drawdowns, making drawdowns less, because you're going to be in a drawdown. There's a really good video by Robert Frey. Okay, if you look at the S&P 500 over the last 180 years or so, it's been in a drawdown around about 75 to 80% of the time. So your account equity, generally speaking, is going to be in a drawdown for a vast majority of the time. The majority of the time, you're going to be in a drawdown. So again, you want to be actively controlling, okay, how much you're losing, trying to position yourself beyond the possibility of defeat as soon as prudently possible. So these pops here, if it's going up, around about 8%, 7%, 9%, 10%. Invariably, 9 times out of 10, there's going to be a logical place for me to push my stop loss up to. So then if price comes back like this, and again, if you've been trading over the last 18 months through this kind of bear market, it really started in Jan-Feb 2021 when growth was topping out. This happens a lot. So this active risk mitigation can really help. Instead of getting hit with that 7% stop loss and losing 1% of your total account equity, you're just coming out break even on the other side. So hopefully that's kind of making sense. So with me, I would rather sell 1/3 here and keep a wider stop loss than just go stop loss break even and keep my whole position. Now the reason is because invariably, again, the vast majority of the time, there's going to be some form of testing action. So what I would then want to do is try and sit through the testing action and then play it for the bigger move. So when we've mitigated the risk, then we're moving into the optimizing profits. Now with the optimizing profits, okay, for me, I'm going to be riding the 1021 EMA. So I'm looking for closes below those. Then I'm going to sell 1/3 and 1/3. However, if price starts getting extended, and I'll draw it over here. If price starts getting extended from the 10 EMA, then I'll be looking to choke off part of the position. It kind of depends on the action, whether I do part or all of the position, how big kind of the gain is, what are the candlesticks, what's the volume profile as well. But over here, right, imagine if I was using, instead of the 1021 EMA, if I was using the 21 EMA and the 50 SMA. Well, up here at the top of this rally, we may go, well, on a short-term basis, this is extended here, okay? It's broke out from a previous base down here. It's broke out, the stock's now up 50%. It's extended from the 21 EMA. So this is where a really effective strategy that I use is lower the day, lower the day, lower the day, lower the day, and deliberately choking it off. So yes, I'm then looking for these closes below key moving averages, but if price starts getting extended on a short-term basis, I will go lower the day. So imagine if these were candlesticks or bars, lower the day, lower the day, lower the day, and then I'm just trying to choke it off. So then in here, okay, this, if I make that red, that is where I would then be stopped out up here. Does that make sense? So again, that's then in terms of the optimizing profits. Why? Because again, if you're trading breakouts, Okay, if you're following kind of a similar strategy to Livermore, Darvis, O'Neill, Minervini, Zanga, whatever, you're trying to follow the trend. Now, you have no idea whether that trend from the base breakout is going to be 5%, 50%, or hundreds of percent. You have no idea. Now, for me, the 80-20 rule is very applicable to trading as well. It basically means that 80% of your profits are going to come from 20% of your trades, and 80% of your profits are also going to be made in 20% of the time. So having that patience embedded as well, really, really key. Something to be working on. So getting those big trades right, the ones that do go up 50%, a couple 100%, whatever, they're obviously going to be in the minority, but getting the 30%, the 50%, the 75% gains, and then trying to stay in there as well for those longer term moves where you can get a double, a treble, a quadruple. In 2020, and early into 2021, stocks were going up 10x. They were going up thousands and thousands of percent. So getting those right, managing those right, I think is really key. So an effective strategy is trying to ride the moving averages, but if price starts getting extended, which again you'll just be training right for, you may have seen some of the bar by bar videos as well, the deliberate practice nature of it. Stop loss, lower the day, lower the day, lower the day, or if you're on the weekly, lower the week, lower the week, lower the week, lower the week. Just letting the stock trying to just trying to play the trend out, basically, because that kind of last portion of the move as well, this kind of last portion can oftentimes be the most kind of climactic in nature, where you get the biggest gain in the shortest period of time. So you don't necessarily just want to be selling here because the stock, well, it's up 30%, I'm up 5R, my initial risk. Well, okay, great, but what if the stock went up another 30%, went up another 100% from here? And actually a much more effective strategy would have been you going lower the day, lower the day, lower the day. Of course, you can kind of tweak these for yourself, you can develop your own process. I'm just telling you what I do, how I trade the VCP. So I've probably spoke enough on VCPs there in terms of identify, control, mitigate, and optimize. Hopefully that video was helpful for you. If you want to learn more about this, there are various links down below. Thank you very much for watching, guys. Any comments, any questions, leave them down below. I'll do my best to reply to you, and thanks for watching.